As per an estimate, India has close to 74 million demat account holders. And with the IPO of LIC expected in the next couple of months, the frenzy that has been created because of this IPO, it is expected that anywhere between 7.5 million to 10 million demat account holders will be added purely to participate in the IPO of LIC. And this would be the largest participation by non-financial investors in an IPO in the history of financial markets. If you are also somebody who's caught up in this frenzy and wondering whether IPO investing is for you, watch this video till the end, wherein I help you decide whether you should be putting your money in an IPO or not. Hi, my name is Harshvardhan Dawar and I am from Wealth Cafe, where we help you make smart money decisions. A fair trade is one where both the buyer and the seller have the same information with respect to the market that they are taking a part of. Well, this is the most important principle of a good market or a fair market, and this is the principle that gets violated when you're dealing with or planning to invest in an IPO. When a company comes out with an IPO, they are coming out to the market for the first time and showing their history with respect to how they performed in the last few years. But in an IPO market, it is always the seller or the company coming out with an IPO which always has more information than you as a buyer, because for you, the company is completely new. They have just come to the market. They've just shared the information that they need to share as per the regulations, because of which they are always at a more advantageous position compared to you as a buyer who has only limited information about the company which is coming out with an IPO. This is one of the biggest reasons why an IPO is something where you, especially if you are a novice investor, an investor who's just starting his investing journey, should completely avoid investing in an IPO. To help you understand this better, let's look at the numbers of the calendar year 2021, during which the stock market had only one way to go, that is up, up, and they went only up all through the year. If you look at the numbers of the calendar year 2021, there were more than 100 plus IPOs that came out into the Indian market. We looked at close to 65 to 70 of those IPOs of companies of a certain size to understand how well they performed. Now, when these companies listed in the market, we saw that close to 48 of these companies listed at a premium, whereas about 19 companies listed at a discount. So that gives you a percentage of 72% of the companies that came out with an IPO listed at a premium. Listed at a premium meaning the IPO was sold at a certain price, but when the shares started trading, they were trading at a premium to the price at which that they were sold to you as an investor. So we had a weightage of 72% of shares trading at a premium and about 28% of the shares trading at a discount, which looks like a decent bet, right? If you fast forward just 2 years into calendar year 2022, at the beginning of March, if you look at these numbers, we have just 28 companies which continue to trade at a premium, whereas rest of them have gone into losses. That means less than 2 months after the close of calendar year 2021, what we see is that just about 40% of the companies that came out with an IPO are still trading in the green, and rest of them are actually trading in the red. While this is still a bit comforting, it gets worse when you get into the numbers of how much of green are those companies in and how much of red are those companies in which are actually trading in the red or trading at a loss. Let's take up the example of 3 of the largest or the most talked about IPOs that came out in the calendar year 2021, that is Paytm, Nykaa and Zomato. Let's first take up Paytm, which was launched at an IPO price of 2150. It listed at a price of 1950, that is at a discount of 9.3% on the first day that it was traded. So it actually listed at a loss of 9% on listing. Next, if you look at Nykaa, which was one of the most talked about IPOs because of the bumper listing that it had, it was issued at an IPO price of 1125 and it listed at a price of 2001, resulting in a premium of 78% on the listing, which is the returns that you make as an investor on the first day that particular share was trading, right? This definitely calls for a fantastic listing for a stock. Next, let's move to Zomato. Zomato came out with an IPO price of 76 and when it listed at a price of 125, resulting in a premium on listing of close to 66%. So you can say that while Paytm had not such a good start, where it had started with a loss of minus 10%. Nykaa listed with a premium of 78% and Zomato listed with a premium of 66%. While the listing premiums or discounts that you see is just half of the story, let's look at how the shares are performing today. That is in the beginning of March, when we actually did this evaluation of whether IPOs is something you must invest in or not. If you look at the price of stocks in the beginning of March 2021, Paytm was trading at a price of 798 rupees, having lost 60% of its value compared to its listing price of 1950. If you look at Nykaa at the beginning of March, it was trading at a value of 1291, which is a premium to its IPO price of 1125, but compared to its listing price of 2000, it has lost another 35% of its share price, that is 35% of its listing price. And Zomato, which listed at a value of 125, at the beginning of March, it was trading at a value of 80 rupees per share, having lost 36% of its value compared to its share price on the listing day. So you can see that some of these stocks, even though they were listed at fantastic premiums, they lost most of the value or most of the premium they were listed at within few months of being listed, and actually are trading at losses today for you as an investor. Whenever you look at the IPO of a company, one thing which is very important for you to look at is whether the company is raising funds so that it is able to use those funds to grow the operations of the company in the future, or is it what is known as an offer for sale, wherein the existing investors are selling their shares to you and taking the money and going home. When it is the case of an offer for sale, there is no money actually going to the company. All the money is going to the existing shareholders, and it is you as an investor who is buying the shares. So whenever you look at IPO which has a pure offer for sale, wherein all the money is going to the existing investors, or a major component is what is known as an offer for sale, those are IPOs which you must definitely avoid. To summarize this discussion for you, if you are a novice investor, somebody who's just starting off in the markets and is new to investing in stocks, you can definitely and very confidently give a miss to any of the IPOs that come out, only because IPO invest is something which is more difficult to evaluate for you as an investor, and you would definitely be better off looking at a lot of the other options that are available in the market for you to invest when you are a first-time investor. If you decide to still go ahead and put some money in the IPO market, be very clear whether you're putting your money for investing in the market for the long term, that is, you want to buy the stock and hold it for the next 10-15 years, or you are getting into the stock only because of the frenzy that has been created because of the media, because of your neighbors, because of your neighborhood panwala talking about the fact that this is a stock you must buy and it is going to list at a premium. If that is the reason why you're investing in a stock, then you are not an investor. You are a trader or you are a punter who's giving a punt on a particular stock, saying that I will buy the stock for a certain price. When it lists, it's going to list at a premium. So that is when I'm going to make my profit. If you want to do it for that reason, be very clear that you are then investing in the stock only as a punt or as a bet, and you're not an investor who's going to buy and hold the stock for the next 10-15 years. So then what you do is put in your money, make your listing gains, or if you are not lucky, make your listing losses and get out of the stock, because there is no amount of analysis is required for you. It's purely a bet that you're taking on a company, whether it's going to make you a profit or a loss on the day that particular company lists. It's very important for you as an investor to ensure that you get away from all the noise that is created around each of the IPOs that come. Yesterday it was Paytm and Zomato. Today it is LIC, which is coming out with an IPO. Be very clear why you are investing in a stock, what role that stock is going to play in your portfolio, what part of the asset allocation that it is going to contribute to, and then only think of investing in a particular stock. If you know someone who is eager to invest in the LIC IPO, or if there's a friend of yours who's asked you for advice, do share this video with him so that he can understand whether he must participate in the LIC IPO or not. And do like, share and subscribe our channel for freshly brewed content every Wednesday and Saturday.